Concerns, of course, have been weighing on these Palantir shares, despite the company topping third quarter estimates and raising its full year guidance. Joining me now is Gil Luria, DA Davidson, head of technology research. And obviously, Gil, there are two things going on here. There is the fundamental story of the company, and then there's the stock story of the company. On a fundamental basis, in these numbers, was there anything not to like?
No, the results were spectacular. They exceeded any expectations anybody could have. This is a company that's more than a $4 billion run rate, growing 63%. It's more than doubling its commercial business. And these aren't little deals. They have some customers that spend as much as 9 figures on Palantir software. So companies are lining up to use Palantir in order to achieve their AI goals. The government business grew 50%. The government's still leaning more and more on Palantir to achieve its own mission critical goals. The stock is down today. That has nothing to do with the fundamentals from last night.
Okay, so what does it have to do then? Is it just a valuation question and this was sort of a sell the news kind of situation?
More likely. I actually think it has nothing to do with Palantir. To your point earlier, this is more about a risk-off vibe today. Nothing more than that. You can see a lot of the higher multiple, more AI exposed companies, stocks being down today. Again, I can't imagine anybody expected Palantir to do better than they did last night.
I mean, but at the same time, what, Palantir's price to sales are something like 85, the highest in the S&P 500. Even if this company is fantastic, does it deserve the valuation, the multiple that it has?
You know, that's the tough question because the both on the price to sales, price to earnings, EV to cash flow, there's no way to justify Palantir's valuation. It is completely divorced from fundamentals and from any other valuation of any other company, which is understandable because they're doing so much better than any other company. They are by far the best software company. But the valuation, it's hard to justify. It's hard to tie it to a cash flow, a discounted cash flow. It really is. Investors that buy Palantir are buying it because they expect the growth to continue for the foreseeable future and beyond. It's a very individual investor-based stock. And so it's very hard to argue should it be trading at 80 times EV to cash flow, EV to sales, at 100 times EV to sales, at 60 times. It's very hard to argue. These are all arbitrary numbers, and hence the challenge, and hence a day like today where, again, the results couldn't have been better and the stock is down.
Well, okay, so Gil, let me ask it this way then. What is the total addressable market for a company like Palantir, and is there anyone really competing with them directly in what they do?
So there is no ceiling for Palantir anytime soon. Just to give you proportion, again, they're more than $4 billion run rate. Adobe's $20 billion run rate. Salesforce, $40 billion. Oracle, $50 billion. There's nothing limiting Palantir's growth. That's part of the excitement. That's part of how investors are justifying this very high multiple. And then in terms of competition, everybody's trying to do what Palantir is doing, which is help companies get to their AI goals, and nobody is succeeding as well. And it's not an accident. Palantir is an overnight success story, 20 years in the making. They do some things extraordinarily well. They help companies and government agencies collect disparate data sources, combine them so you can use AI without compromising the privacy and confidentiality of those data sources. They give companies the soup to nuts service in terms of all the software components, all the services components, instead of those companies having to cobble that together from different software companies and third-party consulting and internal IT. Those are two very unique capabilities that really nobody else is doing and are actually kind of hard to replicate. That's why Palantir is doing so much better than anybody else. And again, the sky's the limit because at their size, they can continue to grow at these rates for many years.
So, Gil, you've got a neutral rating on this stock. And is it just because of what you said earlier that it's hard to, like, it doesn't fit neatly into the financial models that folks in your business traditionally use? Is that the issue?
That is the issue. I'm just a curmudgeonly old sell-sider, and I feel like multiples matter and have to make sense and at least be anchored to other multiples for other companies or historical multiples. And as we said, with Palantir, that's not the case. The multiple is so high that it really is divorced from fundamentals. But again, great company with a great mission doing phenomenally well.
Gil, I do want to ask you more broadly about the risk-off movement that we're seeing today. As I mentioned, you had the Michael Burry filing, right, about the put options on Palantir, as well as some charts that he posted on X. Is there a bigger question to ask, and where do you stand on that bigger question of where tech valuations are right now? You've heard it all. We've talked about it before, the circularity of the spending with OpenAI at the center. How are you thinking about it right now?
There's two categories. There's the real companies that are doing real work and are actually not trading at a very high multiple. Microsoft, Amazon, Google, and Nvidia. They are building an AI infrastructure, and they all told us last week that they saw a positive inflection point in AI demand. There is increasing need for compute, and those companies are responsibly building out that compute. There's a whole other category of bad behavior, using debt to finance, very expensive debt to finance data center build out, related party transactions where you're investing in your customer and then helping them borrow even more money to buy more of your product. Both things are happening simultaneously. But again, I point out Microsoft, Nvidia, Meta, Google, all trading, Amazon, all trading at less than 30 times earnings. Those are attractive valuations for companies that have seen a positive inflection point. As you start getting into this more speculative bets, your Oracle, your CoreWeave, your Oklo, those are extraordinary. Even your AMD and Broadcom, those are extraordinarily expensive on what is much more speculative, much more reliant on the ability to raise debt capital, expensive debt capital that may or may not be available for very long. So those two things are coexisting. It's important to focus on the real companies doing the real build out based on real demand.